Thank you, Dr. Tiriongo, and everybody who has made time to be here for the presentation. I almost called my friends, we take a photo at that, or we take after that. Okay, so in the interest of time, so my name is Rogers Ochenge. I'm from Kenyatta University and also associated to Strathmore University. I'm here to kickstart a debate on an interesting, but quite not really new, but an interest angle to supporting MSME financing. So let me begin by quite an observation that has been made quite for some time now about the importance of SMEs, and I don't think I need to spend a lot of time. In the morning, I think one of the speakers mentioned that 98% of our farms are SMEs. So I really do not need to spend time here motivating the importance of SME. But also, this is from the World Bank Enterprise Survey 2018. Access to credit comes as a key, in fact, second key constraint of farms in Kenya. And so, once again, motivating why we should be interested in SME access to finance. So, SMEs have a few characteristics that are of interest to this study. One, of course, is the insufficient collateral, the high risk of default that they are exposed that characterize this sector. Of course, high transactional cost, and more importantly, the asymmetric information. What is the outcome of this is that, of course, limited access to finance, and we have seen that in the World Bank survey. They will be generally rationed, they will be charged high interest rate, and they may not have access to long-term financing. So the outcome of, the result of this is that we end up with an underdeveloped SME financing market. And this might require some intervention because we have some form of market failure here. So how does then a credit guarantee scheme works? I know because most of us here from the financial industry, we probably know, but just so that we are on the same page on what is our working definition. So in that picture you are seeing there, on one hand we have SMEs, and on the other hand we have banks. In between, you see hurdles which SMEs must jump to get to the other side to get help. And down there, then we have a third party, that's a credit guarantee scheme, which unlocks these hurdles and allows SMEs to access credit. And so the credit guarantee scheme comes and says, I know, and says to the bank, I know you may not lend to this SME, but can I guarantee that in case she defaults, I will be able to cover part of the loan. So, and hence the idea of partial credit guarantee schemes. So there is debate about these programs or these schemes. Globally, the evidence seems to be mixed. On one hand, there seems to be consensus that these partial credit guarantee schemes can reduce risk and can also expand lending. However, what is not clear is what's the impact in terms of pricing. Does the credit, the expectation is that the credit guarantee schemes should be able to lower interest rates to this, so that these SMEs can borrow at a lower rate than if the schemes did not exist. How does this guarantee scheme perform across sectors? That also is not conclusive. But also, there is an observation that if these credit schemes are not well designed, then they can fail. So, in the context of Kenya, we wish to understand whether high impact yet underserved sectors are benefiting from these credit guarantee schemes. Are borrowing costs meaningfully reduced? How do guarantees interact with collateral? Those are some of the key questions. So let me move to, therefore, the key guiding questions for this study. So one, we expect hypothetically that credit guarantee schemes should lower default rates. So the fact itself, for example, that an SME knows that he has an arrangement and he would want to work hard so that he doesn't default and lose that opportunity of, again, because this is a repeat game. So is that the case? Does the data indicate, does it agree with that? Number two, do these partial credit guarantees lower interest rates for MSMEs? Thirdly, are guarantees and collateral substitutes or complements in lender pricing? And then lastly, just a few observations on comparing the Kenyan guarantee scheme with international best practices. So let me quickly just go through the literature that anchors this study. So it's credit rationing. So even profitable MSMEs might be denied loans because of information asymmetry. Banks don't know, they can't perfectly assess these firms. Particularly or specifically, banks struggle to distinguish safe from risky borrowers. That's best known as adverse selection. But they also worry that after the loan has been granted, repayment might not occur, and that's the idea of moral hazard. The result of these information problems is credit rationing, not because banks do not have funds to give these firms, but simply the risk cannot be priced efficiently. So how does these credit guarantee schemes help? Of course, they share credit risk with banks. So by covering part of the potential losses that could arise, these schemes are able to reduce the downside risk and therefore encourage banks to serve borrowers that would have easily not been served. Guarantees also improve credit worthiness because if the SME was to come with the assets and the income that they command, they may not be able to get the loans, but now there is a third party standing ready to offer something that is pledgeable. So this reduces the agency problem that banks would have, and so this allows banks to extend credit confidently to the SMEs. So we achieve two things by these schemes. One, of course, financial inclusion, because we have additionality of loans. We have more SMEs coming into the loop. Interestingly, that also means that now banks are not just lending to a few borrowers, because that can increase systemic risk. They have a diversified loan book. That in itself is good for stability from a from a macro perspective. What does empirical evidence? Empirical evidence does indicate that indeed countries that have well-designed PCGs see higher loan volumes. It has also been found that guarantees can actually reduce defaults, especially looking at the evidence coming from Latin America. Some few things concerning this is taking into account sectoral risk differences. For example, we know sectors such as agriculture, community and social enterprises, because of the volatility of income and also you know, the higher default rates that are likely to, their risk profiles are quite different, and therefore in designing the credit schemes, this needs to be well taken into account. So yes, guarantees expand finance. This is the kind of what the literature is saying, but effectiveness depends largely on the design of these schemes. So our first question is whether, one of our research questions is the impact of guarantees on loan pricing and borrowing costs. What does theory predict? Guarantees reduce loan losses, and because of that, lower risk should mean lower capital provisioning. I know one of the debates or one of the key things is, if I'm a bank, I'm loaning out to these risky clients or SMEs, but then there is a guarantee, then I should get capital relief. Okay, so this is what theoretically we should expect, and therefore, in principle, therefore, this benefit should be passed to the borrower. Is that true in the data? That's one thing that we'll try to respond to that. The literature indicates that in some cases, actually, banks keep most of the benefit, passing little to borrowers. And therefore, we see persistently high interest rates, even to these MSMEs. So we have a chance again to get some fresh evidence from the data that I'm going to share. So for the sake of time, let me quickly go to the data set, and then how I tackle these research questions. So I got access to some data sets. I'm not going to mention the the guarantee scheme, of about 28,356 loans that have been guaranteed for the last 10 or so years, since 2013 to 2024. So the data that I got access to is what amount was loaned, the sector classification, the interest rate that was charged, the collateral status. Was this loan collateralized or not? Then the guarantee coverage ratio, and then whether the loan defaulted or has defaulted at any time since its inception. So it's a rich micro data, but I just want to mention one caveat, even as we interpret the results that I'm going to show. It would really be interesting to see if we have comparable loans that are not guaranteed. This is something we do not have advantage to, and so we are cautious in terms of the results that we get. Nevertheless, we can gain some insights from the data set, from this rich data set. So we have all those variables, and so the first question is, do these PCGs lower default rates? So we have the default rate as our dependent variable and other control variables, plus the coverage ratio, collateral, sector, loan type. So from this, we can learn two key things. One, which sectors actually default most, and then two, does the coverage ratio influence defaults? So that's the first key. Because I know we have researchers here, because the default rate is a ratio between 0 and 1, so it's bounded. So we use what we call a fractional logit to run our estimation. The result of that, before I go to the results, some stylized fact to appreciate what we learn from this data. Number one, there has been, especially since 2020, you can see a spike in terms of the guarantee coverage. That's one. Then two, we also see that the wholesale sector has almost half the loans that have been given out so far. Number two, agriculture and community services emerges as two sectors that are highly covered under this scheme, but also that have relatively high default rates. And so what do we make out of this? One is that indeed this particular program is covering sectors that are highly risky, which is a good thing. Now, we also see quite heterogeneity in terms of sectors dispersion and also in loan pricing. We see some sectors, some loans that are issued at interest rates above 35%. But we see even within one sector, loans are issued at very different interest rates. So that's just one stylized fact from this. Yes, guarantees might increase credit volumes, but they do not impact loan rates or borrowing costs at, I mean, there is wide disparity in terms of this. And could it be that the banks have not really integrated this scheme into the pricing framework? Maybe just an open question. The same thing happens to the loan facilities So from the data set, there are many, like when an SME is taking a loan, what are you taking that loan for? Is it for working capital? Is it for asset finance and all? Is it trade finance and so on? And we also see the heterogeneity. So for example, the term loans get the highest interest rates, which is not really surprising. But we also see there are sectors that are covered even up to 90% on average, like trade finance. Collateralized, sorry. 90% of those loans for trade finance are collateralized. Again, another open questions. Because if you look at their default is low, could this be a case of over-collateralization? Again, another open question. Anyway, so what determines default in this sample of guaranteed loans? Number one, those sectors are against agriculture. So for example, community defaults more than even agriculture. But the other sectors are less risky than agriculture. So the base sector is agriculture. But then of interest here is the coverage ratio. So the coverage ratio indeed does reduce default. This is across the loans. This is a cross-sectional model. And then also collateral also reduce default, which again is pretty standard. So the key message from this is that indeed, yes, to the answer to our research question, yes, they do, guarantees do reduce default rates. Now, what about the second research question is about borrowing costs. So we have interest rates against interest rate is the dependent variable, and those variables you are seeing there: default rate, coverage ratio, collateral, and then sectors indicate. So what we have here is just the marginal effects. So for example, default rates is quite strong, which means this is loans are well priced. If you are likely to default, you are given a higher rate, and coverage ratio reduces guarantees reduce borrowing cost, although not as strong as default rate or collateral. But then of interest is the last row, an interaction of coverage and collateral. And the message from that estimation is that guarantees and collateral act as substitutes, which means if already a loan is collateralized, the guarantee has little impact in lowering interest rate. That's the key message from that regression. So guarantees and collateral act as substitutes. Now, what would be the ideal situation? The ideal situation would be that if a loan is collateralized and again it is guaranteed, that should reinforce each other and get a lower rate. This is not what we see, at least in the data set and the specification that we use. Now, the last research objective was trying to, now we know that Kenya National Treasury recently introduced a public scheme, the Credit Guarantee Scheme. It was launched in December 2020 and was piloted with about 7 partner banks. And by December 2023, about 4,000 loans had been issued worth 6.18 billion. And 71% were new SMEs that had not at least borrowed from the bank. So this is really quite encouraging. But the lending is still concentrated on trade sectors. Now, of course, currently the scheme is housed in Treasury. I'll make a few comments on that. So, away from the public, there are a few other credit guarantee schemes. We have African Guarantee Fund, we have Propaco, we have DFC, we have a few other that this is not exhaustive, but that is just to be aware that there are still other schemes. So, what we found from international best practice, I'm going to make a few observations. One relates to governance. Who should be a credit guarantee scheme? Should be an independent legal entity, should transparently indicate the funding, because if you are going to guarantee, that means you have funds to pay off to the banks if the SMEs cannot pay. So there should also be clear supervisory interface. So examples of some best practices, we have one from Korea. Korea have a public credit guarantee scheme, which is independent, which is an independent institution. It has clearly set solvency safeguards. It has differentiated coverage ratio. So, in fact, beginning 70 to 85, I was reading the Kenya National Treasury had as low as 25%. We have another good case from Morocco that is a dedicated public financial institution, higher ratios for women and micro farms. So what can we learn? What lesson do we learn from here? Perhaps convert the public SGS into an independent entity and then have formally the central bank oversight, because they have advantage given the oversight the other financial system. Number two is product design. That's another key design issue about these credit guarantees. Having differentiated coverage ratios, I've mentioned about that. High coverage plus structured allocation. So for example, you will see, in fact, the data that we used had an average of 50% coverage. So that means the SME goes to the bank and this guarantee scheme says we will pay 50% of the defaulted amount, and the bank will bear the 50%. Now, that is also a design issue. Maybe we should have a menu of different ratios. So, also, what are the fees? If I'm a bank and I'm going to receive this credit guarantee, the fees, are they risk-based? And then also ensure contractual pass-throughs so borrowers benefit from lower cost. So, what should separate one best bank from the other? A bank, and I'm going to talk about one example of Chile that Chile has. But here, how do we ensure that the benefits of these schemes are passed to the borrowers? There has to be some incentive mechanism to do that. Then allocation mechanism. This was quite interesting. So, which banks should be supported under this scheme? To avoid rent seeking, there should perhaps be an auction. This is what the FOGAPE, which is the credit guarantee scheme in Chile, does. So banks submit bids. So a bank says, I want to participate in this scheme, and this is the coverage ratio I would like. maybe just cover 20% of this, or cover 60%, and then banks can compete on that. So that's one lesson that maybe we can pilot the auction-based and also performance-linked allocation. So in conclusion, sorry I have taken a little bit longer. I had so many things to say. Hours are the ones that are few. And so we analyzed 28,000 MSME loans under the Kenya's PSG program, and we examined sectoral risk and loan defaults, the impact of guarantees on borrowing cost, and then benchmarked against international practice. So, what are the key findings? So if we can summarize: one, the sectoral heterogeneity in risk. For example, agriculture community have the highest default rates. Manufacturing, electricity happen to have the lowest default rates. We also observed that both collateral and guarantees reduce risk, although collateral is still stronger in this. Number two, borrowing costs shaped by loan structure, not so much about the guarantee scheme. So there are structural issues still perhaps that we need to solve so that we allow the guarantee scheme also to have an impact on borrowing costs. And then we also have highlighted the design gaps that we can learn from global best practice. So in terms of policy recommendations, a risk-based guarantees design, differentiate coverage ratios across sectors, higher protection for higher risk, high impact segments, and then also improve pass-through to the MSMEs, introduce pricing benchmarks, let banks show that they can, the best banks that pass through the benefits to credit to SMEs are the ones that are benefiting from the scheme. Then of course I've talked about the institutional reforms, the competitive allocation, that's the auction-based, the independency of this to also ensure there is going to be fiscal stability. Thank you so much. In conclusion, Kenya's PCGs expand MSME finance, but there is still a lot of potential that remains underutilized, and also trying to align the schemes to global, with global best practice. This will give us will bring about stronger financial inclusion, SME growth, and support for Vision 2030. Thank you.
Thank you. So I quickly invite Radha to give her discussion of this paper. Then we'll open it up for Q&A. Radha, please know that you're sitting between us and lunch.
So good afternoon, everyone. Yeah, thank you. I'll try to keep my comments quite brief. My name is Radha Upadhyaya. I'm from the Institute for Development Studies, University of Nairobi. And I want to thank the KBA for always hosting such an interesting seminar. And Daktari and I, we've, even 2 years ago, I commented on his papers. So I always very much enjoy reading his work. I don't know if my comments can be. Okay, so whilst I'm waiting for the slides to load, I just want to say I can start with the the initial, what I was saying, my first few slides. So first I want to say that I really appreciated this paper because it actually really highlights a key challenge. Today's whole day, but as the governor said this morning, we have high financial inclusion, but poor financial health, and we have not cracked the nut of lending to MSMEs. So all these papers, around this are really trying to tackle a problem that's very pertinent in Kenya, and I really appreciate the Kenya Bankers Association and the authors for doing it. And also to whoever shared the data with my colleague, I really want to thank that. It's very relevant. The data is real world data. So it's not just a model, and I really want to appreciate whoever the financiers who shared it. Sorry, there seems to be an echo, I hope. My main comments, which I'll go in detail, are around the theoretical and conceptual frameworks. So as Mwalimu explained, the main idea is, do these partial guarantee schemes achieve an intended impact? But I feel that it really needs to be more of a development of like the theoretical and conceptual framework and kind of a theory of change of how you think the impact should be. And then when I go into the conclusions, I must say the findings are not unexpected. And whilst Mwalimu focuses on the comparative study in institutional design, I feel that this necessarily may not be the answer. Quickly, again, the title refers to pricing and risks, but the main issue that was discussed is defaults and borrowing costs. So I think this again ties down to my need to really focus in onto a theoretical framework. So once your research design is very clear, the independent and dependent variables are clearer, it will automatically kind of make the paper flow better and have a bit more kind of idea of like what is the key reasons why these partial guarantee schemes have not led to reduction in borrowing costs for the borrower. I feel that the theoretical framework needed a bit more development. When you read the paper, which is well written, there's a focus on things like information asymmetry. I'd like to contend that partial guarantee schemes do not reduce information asymmetry. The reason we need them is because banks have not been able to reduce the information asymmetry. So when you say that these are the channels, we really need a careful thought on what we see as the channels through which partial guarantee schemes can have different impacts. And when the dependent variable is access or defaults or borrowing costs, each has a distinct, maybe differentiating, mediating variables. And then that sort of conceptual framework then needs to be used to justify the model. Whilst I'm not saying that the fractional logit model is wrong, we can't just say you're using it because this data is between 0 and 1. Yeah? You need to have a theoretical reason why you're using that model. And for the borrowing costs as well. So it's not clear to me why no macro factors were included in the fractional logit model. And I'm not saying it's right or wrong, but I think it's like if it came from the theory, it would make more sense. And also in the OLS model, I'm also not 100% clear how endogeneity is dealt with because you have things like interest rate as independent variables. So there needs to be some sort of better explanation of that. And particularly in both the theoretical framework and the writing, there needs to be a discussion that this paper is looking at impact kind of on two sides. On the demand side, so banks don't want defaults, so it's trying to answer that question. And sorry, that's the supply side. And then on the demand side, borrowers want lower costs. So often these two sides get kind of confused when we're thinking of this kind of whole impact of partial guarantee schemes. So, and there needs to be a clear link of how the Kenyan context and the institutional design of the Kenyan context is taken into and shapes the model. The literature review, I know this is a new area, but I feel it needed a bit more depth, even the papers that were discussed. For example, one of the papers cited, similar to Kenya, has very limited pass-through of the partial guarantee schemes to borrowing costs. And this paper, according to the author, the reason is guarantee fees, administrative cost, and sector risk perceptions. But then we kind of make this jump to institutional design. So I feel, again, coming back, if we have these conceptual frameworks correct, and then we see, when we say institutional design, are we still talking about guarantee fees? It's a bit unclear. So in the Kenyan context, there's also limited pass-through, and then we say that's because of institutional design. But this jump of why, guarantee fees or administrative costs, there some may or may not be part of this design, is very important. And so I feel there needed to be explicitly a more, in the literature, a discussion of what is institutional design. I personally feel there's a big problem with calling anything international best practice. Yeah? There's nothing international that's best practice. Any kind of global standard, if we adapt it to Kenya, we need to see what is relevant for our context. So the literature review also has kind of completely ignored some of the political economy factors shaping partial guarantee schemes. And I think we need to move beyond some of these kind of institutional design as this sort of holistic thing, but also try to say what are the Kenya specific factors. Again, this may not be possible to do in every paper, but we need to highlight it and keep it in mind. There are macro factors like high government borrowing, which constrain lending dynamics. We need to at least highlight the importance of that. And then micro factors. Who monitors the monitor? I've done some other work on patient finance, which is long-term understanding finance, and this is tangential, but in that paper we showed that when banks get lines of credits from DFIs do not monitor the banks. They just assume that the banks are doing the right thing. So similar to this, it's like there's, this oversight gap, this idea that we just have this transparent institution kind of hides the really detail that we need to go into of the context-specific macro, micro, and other political economy factors, which mean that the partial guarantee schemes have at least not led to the effect that we were expecting. Some comments on the data. Again, kudos to Mwalimu for accessing this data, convincing people to give it. I know data is not easy to find, but there was like almost 20% of the data set was removed due to missing and inconsistent values. And that's not insignificant, like that really needs to be explained. There's quite a lot of descriptive statistics in the paper, which is really nice, but I feel there needs to be a bit more discussion, particularly of figure 1. There's some parts, like there's a fourth figure on default rates, which I just don't understand that. And then there's a discussion on the lending landscape and the partial guarantee landscape. I felt that that should come like at a preceding level. So then that landscape influences how you design the conceptual and theoretical framework. On the default model, again, I'm a bit, again with data, it's a bit hard. There's a 0.2% reduction in default. Now, whilst this is statistically significant, I don't feel it's economically significant at all. And we all know how much government, private sector, FSD Kenya, Treasury time has gone in designing these schemes as a solution to the lack of access to SMEs. So the author himself says, this would help with higher volume lending. I don't think this is high volume lending. So before we interpret this as a very positive outcome, we need to be really careful by saying, actually, no, default rates, 0.2% reduction, that's not great. Why? Yeah. And on borrowing costs, I feel actually there should be a bit more clarity of what was the expected hypothesis for each of the independent variables. And I feel there needs to be more robustness checks, because the standard errors are quite small. And I feel a lot of the correlation is presented sometimes more in a causal way, but just to highlight that this is correlation. This is not an experiment. Mwalimu himself said we haven't compared this to where there were no guarantees. So we just need to be careful about what we write. Now, comments on the findings, and this is why I love KBA conferences, because it's the bankers here and people are not scared to tell the bankers what they think and what the challenges are, and bankers are prepared to listen to them. So the outcome is not unsurprising. Collateral is still king, and banks show limited pass-through to lower costs. So to add to this, we need a bit more explanation of why these patterns persist. Yeah? And I would suggest that maybe you need to complement these quantitative results with some qualitative results for interviewing both the bankers and the borrowers. So my final remarks, thank you again to KBA for ensuring that papers like this are presented in this seminar. It's a very timely analysis. There needs to be more of a very clear theory of change, theoretical framework, clearly explaining the two models. I think we need a bit more discussion of what is institutional setting. So the institutional setting is the key explanatory factor that's been given to explain the low transmission, but it's too general, like independent, transparent, have an auction. I think some of those things are too, again, a bit too borrowed from other contexts and other countries, but don't necessarily explain why we've had limited pass-through and lower borrowing costs. And one of the suggestions is to complement it with qualitative insights. I think it'd be really interesting to extend this analysis to see that the firms that got these credit guarantees, how it affected their performance, so firm borrower performance. And in terms of policy implications, again, I feel this is a suggestion for every KBA paper that I have every year. Instead of saying, these are my policy suggestions, say, these are the policy suggestions for banks. Like today, if there's a banker here who's working on the partial guarantee schemes for their particular bank, what can they do? What is the suggestion for the regulator, the suggestion for a market actor like KBA? So I think policy suggestions need to be more specific and from the actual data. But again, thank you very much to this paper. I really enjoyed reading it, very rich analysis. Thank you.
Thank you, Radha, for a very comprehensive discussion. I want to request something in the interest of time, and I think we've also been requested by the hotel that we proceed for lunch. Now that we have another paper on credit guarantees coming up in the afternoon, we would want that also to be presented, and then all comments can be given at the same time and directed to whichever paper that you deem you want to comment. So I beg your indulgence again that we proceed for lunch, and then when we have received the next paper on credit guarantee and MSME financing later in the afternoon, then we can actually give comments for that one and also for this one. Secondly, there will be a small change in the program, again in the interest of what is emerging, the pricing concerns. I know even the governor emphasized this morning around the new innovation in pricing. So the KBA internal paper that would have been presented today initially in the program at 2 p.m., we are considering to do a sort of presentation just to highlight what are the building blocks to the new pricing model, with one very basic reason. The 100 of us that are seated here today can quickly be our ambassadors as we go out there if we develop an understanding on the pricing framework that is coming. So soon after lunch, we will have a session on the risk-based credit pricing, and then we again revisit the paper on credit guarantees and then generate comments together for this paper and that other paper. So I wish as well as we proceed for lunch, and then it is, what's the time now? I'm looking for 1:27. So could we come back by 2:20? 20 minutes past 2. And then we start off from there, and then in the hope of picking and getting to our program as scheduled. Lunch will be served on the third floor, Acacia Restaurant. And all of us, as we exit the room and go up to third floor, will be given meal cards so that then we can enjoy our lunch. So enjoy your lunch, and see you at 2:30 for us to resume the rest of the program. But look forward to very exciting session in the afternoon. Enjoy your lunch. Thank you.